Right, welcome to another video. So in this video, I'm going to break down the US debt problem and if it is really a problem. And the big question that everyone really wants to know the answer to really is, how does it affect the stock market? Because that's really all most people seem to care about. So the US debt problem. Now, how big is the debt? What, 34 trillion? Some crazy number. If you had to put 34 trillion into time units, it comes out at 1.1 million years. So it's just a number we can't even comprehend at this point. It's just that big. And you see a lot of stuff on the news like what's going to happen, how we're going to repay this debt, how's the US going to repay it, what does it even mean, who do they even owe it to, all these sort of questions. And there's a method to the madness. So where should I begin? First of all, how can a country even get away with this much debt? Well, the US owns the money, right? The US owns the global reserve currency, the US dollar. So they are able to print as much money as they want without having any repercussions, really, because they can't really bankrupt themselves. A lot of people think they can go bankrupt, but they really can't. And that's really what I'm going to break down. Just to put it into perspective, people don't think about the bond market. The bond market is 55 trillion, whereas the US stock market is 49 trillion, so it's actually bigger than the stock market. The bond market is where the real money is made. The big money gets made in the bond market. Now, although in my videos I talk about never sell a stock, it's different for a bond. A bond is what you really want to buy low and sell high. Okay, this is not financial advice. Nothing in my videos are financial advice. So, what is the US debt ceiling? Why do they keep talking about this US debt ceiling? It's like, oh, we're going to remove the debt ceiling. We're having negotiations about removing the debt ceiling. It's a complete formality. It's political theatre is really what it is. It's a question where if the debt is owed, say I am the bondholder, okay? I'm the bondholder. I have bought a US Treasury and it's time for my repayment. Okay, let's say it's a 2-year Treasury and there's no more people buying mine. It's expired. The US need to owe me this money back. So their debt ceiling is capped. They're not wanting to issue any more new bonds. So how do they repay me back? Well, they have to raise the debt ceiling. So they have to go to Congress and the politicians and say, can we issue another bond to repay Chris? Right? So what does that mean? They issue a bond, and let's say you buy the bond. So you buy a 2-year Treasury. That money goes to the US and they pay me back. Okay, and then 2 years go by. How do they repay you? Well, let's say I decide to buy a bond. So I buy another bond. They pay it back to you. It's like a giant Ponzi scheme, right? That's basically what it is. In an informal way, that's really what it is. And the bond market makes too much money for the dollar to ever fail or the US to fail. There's just too much money getting made by the big institutions, wealth funds. They're making money. I'll tell you exactly how they make the money. A US Treasury has to be the safest investment anyone can really make. Because they own their own currency, so they can never default on the payment. The only time they would default is if they refused to raise the debt ceiling. This formality. Okay, it's just red tape, which is going to happen anyway. They're going to raise the debt ceiling anyway. So it's just to look like they're responsible. It's to appear like they care about this debt and, oh, it needs to be managed and we're using fiscal discipline and we're going to do things to pay it off. Okay, I'm here to tell you in this video, they're not going to pay the debt off. They're never going to pay the debt off. In fact, they're going to keep bringing in more debt and it's going to keep going on as long as it can go on because there's too much money involved in it. So that's what happens, okay? They need to repay me my debt. They issue another bond. Someone else buys the bond. They use that money to pay me back. There you go. That's the debt ceiling. So the bondholders have got 55 trillion in the market. They own the money. How do you make money from bonds? How do the big institutions make the money from the bonds? A treasury is the only asset where you can get like a 10-to-1 leverage on it. Say for example, a massive institution has a $10 million treasury. They can go to the repo markets and borrow 10x that, so they can get like 100 million in a treasury bond. And let's say it's a 10-year treasury at 4.5%. Okay, so they have borrowed 10 times the money. This is crazy. You can't do this with any other asset, but you can do it with a US treasury bond. Me and you can't do it. Okay, institutions can do it because there's that much. It's for the big money. It's the smart money. So this $100 million treasury, let's say they borrow that loan for 2%. So they borrow it at 2%, but they're getting 4.5%. So they're getting, it's a carry trade. They are making profit on the bond, and the bond can't be defaulted on because the US always can repay their debt. So then what happens when the Fed cuts rates? Their bond goes up in value because the 10-year treasury, they got it when it was at 4.5%, and when the yields go down, the value of that bond is worth more, because now if you went on the market, let's say you went on the market in the future and you got offered a 3% yield on the 10-year treasury, you would rather get my yield of 4.5% so I can sell it to you for a profit, okay, because it's worth more. So these people are making 165% return on investment. A $10 million investment, it calculates at $16.5 million in profit from a bond. The bond market gets completely ignored by retail investors because it sounds boring, it looks boring, they don't really know what it is. It's like, okay, it's bonds, they're boring, they're for pension funds and blah, blah, blah. There's big money in the bond market. If you know a rate cut's going to happen, which is often can be viewed about 18 months in advance, or at least 2 years in advance, we can see that if a rate cuts are going to be taking place, you can invest in bonds and make massive profits on them. Now, it's different to a stock market. A stock, you need to look at earnings reports and the company and this and that. With bonds, it's just yields are up or down, depending on people's confidence in the USA. That's what it's all about. It's entirely run by confidence. That is the US's biggest concern over anything. They want confidence to the world and to investors so that we keep buying their US treasuries so that they can remain the reserve currency of the world. And they just want to keep this going, keep printing money. The debt is only going to go up. It's only going to go up. It's never going to get repaid, and there's too much money involved. At the moment, at the time of this video, the Fed rate is 4.33%. And what's happening, in my own analysis, my own opinion, is the other central banks, okay, the ECB, that's the Europe Central Bank, they've cut their rates down to like 2%. And the other central banks, Japan and others, have cut their rates. So right now, the two banks that have got the highest rates is the Fed and the Bank of England. Now, what I believe is the Fed, if they keep their rates higher than the other central banks, it seduces investors to take the treasury yields. So it sucks in all the liquidity. They become the last man standing to hold their rate high because the other economies cannot handle it. Europe don't have a strong enough economy to keep their rate high. You know, the other European countries need lower rates to function, but the Fed can get away with it. And also the other reason is the tariffs. There's a game of tug-of-war going on between Donald Trump and the Federal Reserve, Jerome Powell. You know, Donald Trump is... The problem with Donald Trump is that he can be quite volatile. So if he's saying things like the Fed need to cut the rates, and they need to do this, they need to do that, they're completely independent to fiscal policy. They're completely separate. They make their own decisions independently. Now, if the tariffs are being introduced, the problem with the tariffs is they do create what's called cost push inflation. This basically means the cost from businesses gets passed on to the customer. They just automatically have to increase prices. If I sell you this t-shirt and I buy my t-shirts from China, they have to then increase it. I need to pay more for that t-shirt. I have to sell it to you higher to make more profit. So that's called cost push inflation. So it's tug of war. The Fed can't cut rates if the tariffs are going to cause inflation. Then they're holding rates higher for that one reason, and the second reason, strengthen the US dollar, because eventually investors will cave and have to buy these US treasuries because they want the profit, they want the money. that can be made because it's a 55 trillion market. So the debt, what's going to happen with the debt? Oh, you see it on CNBC, you see it on Bloomberg. Ray Dalio comes out and says, look, we need to address this US debt. The debt's so bad and we need to fix this debt. It can't go on forever. And it's all just to appear like it's responsible, because the absolute fact is the only solutions they have: austerity, raise taxes. Okay, you want to cut spending, there's literally nothing for them to cut. They need to spend the money. They have the expenses to be paid, and they can't raise taxes because it's political suicide if you raise taxes. What is the solution? Okay, the only solution is inflation. Inflation is bad for people with savings, but it's good for people with debt. It devalues the debt. The debt becomes less and less and less the higher inflation goes. This is why we want to play the same game that the US play, the US government, the US monetary policy. Because you want to have assets that go up with inflation because they have pricing power. You know, let's look at Google, Microsoft, Apple. They can just raise their prices because they have a control over their customer base, and their customers will keep paying it because they have to. So if you own assets and stocks with solid companies that will go up with inflation, you're protected by inflation, whereas your savings account is getting crushed. Even bonds get crushed by inflation. You can't hold a 10-year treasury at 4.5% really for the full 10 years because inflation goes up and you probably have less money than when you invested in it 10 years ago. So there's like a game to be played with bonds. They use them in an intelligent way and to protect portfolios and to be managed in a certain way. And they're good during high interest rate periods. So the absolute true solution to the US debt problem is inflation for one. Let inflation keep going up because it will devalue the debt. And growth. They tell you that they can't use growth on the Wall Street Journal and Bloomberg and CNBC, but it's false. Okay, that's the only answer the US has: inflation plus growth. This is why AI and robotics is the real answer. This is why I believe Nvidia is like a national treasure. The AI race isn't just a case of, it's the tech companies trying to compete with each other. It is the answer to the US debt problem. If they can increase productivity like exponentially using robotics and AI and robots and machines doing all the work and working alongside humans, then the productivity would skyrocket, the GDP would skyrocket, and that would make the debt just look smaller. That's the only answer. You really think you're going to pay off $34 trillion of debt? It's never going to get paid off with taxes. I mean, they probably make about, I don't know, like off the top of my head, it's like 4 or 5 trillion a year in tax revenue. The deficit's 2 trillion. I think it's like 6.9654. I think like 4.9 trillion comes in on taxes or something like that. There's a $2 trillion deficit. Okay, they've got a shortfall of 2 trillion after the taxes have been paid. So that's why they issue bonds to get me and you to buy bonds and they pay off. So robotics and AI is the answer. That's why I'm a strong believer and investor in companies like Nvidia, because it's not just a company anymore. It's the answer to the US's growth, because all these companies need to invest in AI, to develop it, to push it, to create growth. And this debt will look smaller and smaller if the GDP becomes massive, which it can happen and it will happen. Ray Dalio, yeah, the debt is a concern. This is what they want to keep saying. It's all theatre when you watch the news. It's to make it look to investors like they really are taking it seriously and they don't want to just use inflation to erode the debt. Because remember, if the inflation is the answer, they won't buy bonds. Okay, because why would you buy a 10-year or 30-year treasury bill if the US dollar is going to get flattened 10 years from now? You wouldn't buy the bond as a long-term investor. Okay, so that's why the narrative control is so strong. they need to push the narrative of we're doing things to control this debt, to make this debt. We're going to raise taxes. We're going to use tariffs. We're going to use this and blah 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 blah. Okay, I'm not worried about the US debt. In fact, the two answers that I've mentioned, the true real answers, inflation and growth, are only going to help your stocks. If that's really what you care about, is your stock portfolio, it's only going to go up with inflation and it's only going to go up with the excessive growth. So the stock portfolio is going to be fine. Investing in US is going to be fine. There's no way there is even a replacement. Who can replace the US? Okay, China have capital controls. They're not as liquid and open as the US market is. There's not enough trust there. Europe, fragmented, poor economy. The euro's never going to become the global reserve currency. Something catastrophic would need to happen to the USA for that to happen. You're talking like major. There's not even any much things I can think of, okay? But literally nothing beyond World War III and wipeout. Nothing's going to replace this. Too much money for institutions. Too much money to be made in bonds. It's just not going to happen. They're not going to raise taxes. Aren't going to fix 34 trillion in debt. So don't let the theatre fool you. Do not let CNBC and the news channels make you think, oh, the dollar is getting weaker. They say the other trick they use is they say, oh, the treasury yields are high, but yet the dollar is low. That means investors aren't pulling in. Give it enough time, investors will cave and buy in. It's the same cycle, the same loop. The dollar strength goes up and it goes down, but it always resolves at the end of the time. At the end of the day, it's like a loop. Okay, as the sun rises in the morning and sets in the evening, the US will print more debt. So what do you take away from this? Copy their strategy. This is the rules of the game. The rules of the game is get cheap debt, let inflation erode it, and buy assets that go up with inflation. The specifics I will make in more videos. So follow my channel, comment, more information on this is coming out. I've got more specific, I've got honestly a book full of information that I've of my own content ideas that I can make on this topic. The topic of finance in general and investing and this, the secrets that they don't want to tell you. So if you like it, follow, like and subscribe.